I'm here to tell you that it is more than possible to learn to trade with a full-time job. Listen, if you're a middle-aged guy and you've got a family and you're thinking, I can't show up for the open because I'm busy working or I'm just too busy with my family, I don't have time for this, I'm here to tell you that's not true. I learned to trade while I had a full-time job, and it was not a regular full-time job. I was the general manager of a department for a very large construction company. So it was not a full-time job. It was much more than a full-time job. And I learned to trade through that. So I'm here to tell you that it is definitely possible. And what's more, I'm going to tell you how. So the first thing that I'd like you to understand is that this requires a bit of a mindset shift. See, there's something about trading that most retail traders don't know, and it's not because that information is gate kept. They don't know it because they won't accept it. But if you have a full-time job, you're actually in an advantaged position because you have to accept this. And I'm going to share with you what this is right now. It is that trading is not hard work. If you're relying on hard work to trade, you're thinking about trading completely wrong. The way to think about trading is that it's spotting opportunities in the market and learning to capitalize on them. You do not have to be there while the trade plays out. You simply need to be there at a time that works to spot those conditions in the market and then know how to capitalize on that. Once you've set up the trade, you do not have to be there to watch that trade play out. And in fact, I advocate for that actually being very poor for your trading psychology, especially when you're new, to watch charts go up and down and all over the place and all the intraday noise. That's hard on trading psychology. So you will actually be at an advantage. Listen, read the new Market Wizards book, The Next Generation, or listen to it on Audible because in there they talk about a lot of traders who talked for years about the grind and how you have to work super hard. And one especially is Lance Brightstein, right? Scalper, grind super hard. He was all about that. And as of recent years, he's admitting that that grind was not only unnecessary, but it was really hard on his health. It's not a good thing to sit in front of screens and grind. Enough said. Let's show you how to learn to trade while you have a full-time job. So the first thing that you want to do is, of course, when you're learning to trade, you always want to be consuming some sort of material that you don't know. If you're brand new, maybe you want to be consuming some sort of videos on mindset or technical analysis or something like that. The other thing you want to be doing is reading books, like I just said. Download Audible, pay the 15 bucks a month or whatever it is. 15 bucks a month is cheap and download books on trading and read them. Start with the new Market Wizards books. Read all the Market Wizards books, except you're not reading them now. This is your commute. You now listen to books and YouTube videos on your way to work. Obviously, I don't want you watching YouTube videos while you're driving, but you can listen to this stuff. And that's what I did. It was an hour to work and an hour back every day. And I listened to books and listened to YouTube videos. That's what I did. So, as far as actually building a strategy, you probably want to take a little time on the weekends and dedicate that to learning a few strategies. I mean, I can show you strategies, I will show you strategies, and I'm going to highlight my process for one of the strategies that I'm building in the How to Build Edge series because it fits in perfectly for someone who has a full-time job and doesn't have the time to sit there in front of the screens all day. Now, I think it goes without saying, but I'm going to say it anyways. You're not a day trader, right? I mean, some guys can get up at like 4 in the morning and, their time zone is, the right time zone to catch the open in New York or whatever it is, right? And you know what? If you're that guy, the power to you. But if you're that guy, I want you to know that you're like one in 100,000, right? There's not that many people that can do that. So for the average person, I'm going to show you how to do it. Okay, so if you want to know more about this low float gapper strategy that I'm doing, go watch the How to Build Edge series because I go through exactly how I developed that strategy in real time. But the long and the short of it is that, if you're familiar with low float gappers, every morning there's some low float stocks that gap up like 50 or 100% or sometimes 300% or more. And then generally they fade during the day. And generally over the week they go right back to where they were coming from, right? It's really common for retail traders to use this. It happens every day in the markets. These low float gappers are generally always running, and there's generally always some sort of move to take. But what I've done is I know that those shorts get squeezed pretty regularly, like not all the time, enough of these low float gappers fade back down to nothing that the fade move is actually a really great strategy. But the issue I have with the strategy is it's very hard to find locates and you have to be in front of the screen. And I don't want to be in front of the screen. I mean, I've got a scalping strategy, but that's another story. I don't want to be in the front of the screen for this particular strategy. So, what I do is at the end of the day, after the markets close, in the evening, I take 45 minutes. And this is what I did when I was working full time. So, I'd come and I'd look at Benzinga has a very nice pre-market movers. And so we can see here that HSAI gapped up. So let's see that this is from previous days, the previous morning, right? So we're going to type in HSAI and and we can see here that it's a misprint, right? Nothing happened there. Okay, so let's go back. That happens from times to time. Let's go to GMM. So we're going to go to GMM, and what we're going to do is we're just going to track the tickers. That's all we're going to do right now. You're building a strategy. We're just going to track the tickers. And you're going to come home every day after work for 45 minutes, and you're going to track tickers because that's where you start. You start by tracking it, trying to see where the moves are. If you haven't seen my back testing and forward testing videos or how to build a strategy, any of these videos can show you the basic framework of how we do this. But you can see here we got a little gap up. Here's the 5 minute chart. It gapped up in after hours and then in pre-market and then it came down. Now this is the exact move that I'm looking for. It didn't come all the way back down. Instead, what it did is it just kind of created this consolidation area and went sideways. And so what I'm going to do is I'm going to set up a trade probably here. Let's make the daily chart bigger so that we can see. So I'm going to set up a trade probably, I would say about 460. So I'm going to go ahead. I'm trading this in real money right now, but for the purposes of this video and the way that you would be looking to document this, right? Because paper trading is for practice, but it's mostly for documenting. You want to see what happens. So I would go ahead and set up a stop entry order above 460. I would set my stop loss down here. I'm going to go all the way to the low. And then it's however much risk you want to take, you're going to size accordingly. So let's say we were wanting to take $500 risk. And again, I mean, it's paper trading. It doesn't really matter, but you're trying to build some good habits. And we would aim to take a 2-to-1 risk to reward. Now, I've done all the work on this, already, and you can see that in the How to Build Edge series. So I'm comfortable with the 2-to-1 risk to reward. That's giving a very strong return for this strategy. But when you first start out, like let's say you don't start out with this specific strategy, you start out with a different strategy, And you can start it with any swing trading strategy you want for this. You're not going to know if a 2-to-1 risk to reward is the right risk to reward. So you might just be tracking tickers at the beginning, or you're just blindly placing a take profit here, and you're just going to go back and review and see what happened, see if there's a better way to trade it. You just got to start somewhere. You got to start figuring it out. So then what I would do is this is going to be enforced for a week. So what I'm looking for here is for this to continue to grind more or less sideways into tomorrow or the next day, and then it'll squeeze higher. And when it squeezes, all these shorts that were hoping that this would continue to grind down are going to have to buy. And they generally buy up into this 2-to-1 or higher. If it goes higher, I don't care because I get enough 2-to-1 risk to reward trades that it works out in my favor. So that's how I do it. I come back in the evening, I set this up, I go to my spreadsheet. You can see since April 22nd, I've been logging all these trades. And I am going to go ahead and log a bunch of information about this particular setup here. So the ticker is GMM, and we gapped up in pre 203%. So I'm going to go ahead and record that as I have been. And the date was July the 10th. Okay, so you can see here I've recorded a bunch of data. Now this is all stuff that I've came up with, in my years of experience of, doing a lot of back testing and forward testing and developing edge on strategies. I'm not going to get into all of this today. The key highlights would be that you'd want to record your price and your gap ups and your float, right? Because the point is to pick low float stocks because there's not that many shares, and because there's not that many shares, it causes the price to squeeze higher. And of course, your date and your time. Now, it's not that there's no hard work involved here. I'm not saying that. What I am saying is that if you come into this with the mindset that it requires hard work to have success, then you're going to discourage yourself from day one. And you're not going to want to do this. You're not going to have time for it. It's just going to be discouraging. It's not what it's about. It's about learning to find opportunities and capitalize on them. So when you track all of these tickers, the hard work then is to come back and analyze them on the weekend. And now I'm not saying that you need to spend 12 hours a day all weekend, every weekend looking at this. I would spend probably between 2 and maybe 6 hours on a really heavy weekend when I was working full time, and I did not do that every weekend. I did that about once a month. I would just go back, review everything, and see what I can find. If you don't understand what I mean by see what you can find, again, go back, watch my back testing and forward testing videos, and you'll understand more what I mean there. So this is something that you can do in 45 minutes in the evening, maybe even half an hour. It doesn't have to be this strategy. Another example is FinViz. Obviously, FinViz is used a lot. Sorry, I should have mentioned on FinViz, I use the top gainers list on that strategy as well. But yeah, again, if you watch the How to Build Edge series, I'm also working on a mid-cap momentum strategy right now. So I've got my screeners built. I've got a whole bunch of screeners built here in FinViz. But here is the specific mid and small cap momentum strategy screener that I'm using. And I'll go through this and I'm looking for sectors that have you know, hop. There's momentum in that strategy. There's a fundamental driver. So I'm building a strategy around that. Same thing. Come after the market's closed, look for the stocks that fit within the criteria that you're scanning for and record it. One that I specifically did when I was when I was working full time, as I said, is a 52-week high scanner. And there I wasn't necessarily looking at the time for hot sectors per se. I was just actually I was doing a lot more work than I probably needed to. At the time, I was recording all of the 52-week high screens that came up, all of them. And then over about three spreads, so I'd record all of them. I get like 150 instances, which took me about a month to get recorded into this spreadsheet. And then I'd go back and I'd review. I'd say, okay, which ones are junk and which ones actually moved? Is there any sort of correlation? So then I'd start a new spreadsheet with the new criteria that was dialed in, and I'd only record those. And I'd get like 100, 150 trades. And then I'd do another review after like a month, and I'd dial it in even more. And so that's how I did the 52-week high one. I also did a 50 SMA at the same time. So it took me a little longer at the time, but I think you get the point. This is something, no matter what swing trading strategy you want to use, or in this particular case, if I'm talking low floaters, I'm looking for like an overnight gap type situation, right? This is all stuff that can be done after hours. You do not need to sit there and watch that chart develop. There's absolutely no benefit in watching the chart develop. You can see how the chart developed later when you come back and do your review. You can watch how the chart developed, and that's really all that matters. At the end of the day, all that matters is, did I get executed? And did I get stopped out, or did I take profits? How you get to stop out or take profits really does not matter. It does not matter one bit. I'm telling you now, as an experienced trader who did this while working a full-time job, that it does not matter how you get to take profit or how you get to stop out. All that matters is that it does, and that it becomes a data point in your spreadsheet that you can then go back and review and develop criteria and say, hey, I can set my stop further, or sorry, my take profit further, or I need to dial my take profit in a little bit. You can say, well, the market was doing really well at this time period, and my strategy was doing really well. So that is a correlation that I need to make note of, because if the market's not doing well, then maybe my strategy is not doing well. And so if you keep doing this over time, this forward testing, in your spare time, eventually you will develop a strategy and you will develop yourself as a discretionary trader. If you want to know more about what that roadmap, that path looks like to get from where you're at to consistently profitable, watch this video next. Leave me a like, subscribe, and I'll see you on the next one.